Hello, I am your facilitator, Professor Rosemary Obasi, taking you pension reforms and accounting. To take this course, we are going to be looking at the following. We are going to be looking at brief historical background of Nigerian pension scheme by way of introduction, types of pension schemes, pension fund administrators, fund types, and then a simple illustration of how to identify the relevant items to be recognized in a statement of profit and loss of a pension administrator, fund administrator. Introduction of a brief background of the Nigerian pension scheme. In order to have an in-depth knowledge and understanding of the direction of changes in pension structure in Nigeria, it will be important for us all to understand the antecedents of the pension system in Nigeria. So on this note, we have categorized this pension structure into three different eras as we observe them in the literature. The first is the colonial era, which dates from 1946 to 1960. In this era, pension can be traced to the introduction of wage employment in Nigeria and is firmly entrenched in the history of employment relations in Nigeria as well, which dates back to British colonial administration. Pension scheme was first developed in Nigeria in 1951. That provision, however, took the retrospective activation date of January 1st, 1946. The colonial British administration established a scheme through an instrument called the Pension Ordinance. It, however, had a retrospective effect from 1946 and applied only to the United Kingdom officials posted to Nigeria. This was a limitation. Within this period, only one Nigerian company had a pension scheme that runs and that covers the Nigerian citizens. That's the pension scheme introduced in 1958 by the Nigerian breweries. Outside that, this pension ordinance only covered the British employees. Therefore, the Nigerian employees never benefited from that scheme. Then the next era is known as the pay-as-you-go era, which dates from 1960 to 2004. This era saw the introduction of a scheme known as the National Provident Fund. This program was established by the National Provident Fund Act of 1961, a year immediately after independence. The fund was a compulsory social security savings scheme to which both the workers and their respective employers contribute in equal proportion for the benefit of the workers. The scheme provided for a lump sum cash payment to a subscriber when his employment ceases due to old age or disability. Several schemes came on board after the National Provident Fund scheme in 1961, for example, like the Pension Act number 102 of 1979, the Army Force Pension Act number 103 of 1979, the Police and Other Government Agency Pension Act number 75 of 1987, the Local Government Pension Edit of 1987, and the National Social Insurance Trust Fund Scheme of Degree number 73 of 1993. This particular decree of 1993 replaced the National Provident Fund Scheme of 1994, which involved the private sector. This made provisions for loss of income in old age, invalidity, or death. From 1993 to 2003, the National Social Insurance Trust Fund Scheme, NSITF, was with the aim of protecting employees in Nigerian private sector who were mostly in non-pensionable employment. So that is, this scheme brought in the private sector into the pension scheme. And therefore, this is more so as most employers did not have such provision in their employment contract with their employee. Under the scheme, a portion of the employee's emolument is deducted and remitted to NSITF. Fortunately, the employees that contributed under the scheme did not receive the supposed benefits, as the funds were largely inaccessible. Not until June 2004, when Nigeria had operated particularly in the public sector, a program known as the Defined Benefit Pension Scheme, which was largely unfunded and non-contributory. It defines the benefit of a retiree, determined by a formula that took into consideration the retiree's salary, year of employment, retirement age, or years in the service of the company, and so on. The system was also characterized as a pay-as-you-go scheme, since retirees were to be supported not by previous contributions, but by annual budgetary provisions. Because it was largely unfunded, the defined benefit system led to massive accumulation of pension debts, which was estimated at more than 1 trillion naira. In response to the prevailing effect of such a system on the lives of our elderly people, otherwise known as senior citizens and their families, the government in 2004 decided to take measures aimed at reversing the situation through developing a system that is suitable and has the capability to achieve the ultimate goal of providing a stable, predictable, and adequate source of retirement income for each participant. Accordingly, with the coming into force in June 2004 of the Pension Reform Act of 2004, a new pension scheme came to replace the previous defined benefit scheme. Then that takes us to the third era, which is known as the democratic era or the contributory pension scheme era, which dates from 2004 till date. The new scheme is a defined contribution scheme. As its name implies, it requires the contribution of both the employers and the workers, that's the employees of all companies, to contribute 7.5% each of the emolument of the employees into a retirement savings account. However, this 2004 Pension Reform Act was repealed and reviewed in 2014, which brought about the Pension Reform Act of 2014. The new act, which is still running to date, changed the compulsory contribution by both employees and employers from 7.5% to 8% for employees and 10% for employers. And it also brought in several unique fund types, which we will see as we move on. It is important to state that in the Pension Reform Act of 2004 had 4 multi-fund structures: Fund 1, Fund 2, Fund 3, and Fund 4. But when this 2004 Pension Reform Act was reviewed in 2014, the multi-fund structure was now increased to 6 different funds. Fund 1, 2, 3, 4, 5, and 6. The Fund 1 is defined, the funds are defined by age. For Fund 1, they are all employees within the age of 49 years and below. And this fund is by choice. Fund 2 is a default fund for all active contributors that are 49 years and below. Fund 3 is also a default fund strictly for all active contributors that are 50 years and above. While Fund 4 is slated for retiree fund for those within the age of 60 who retire within the age of 60 or 65 or even 70 years, as the case may be. Fund 5 is strictly for contributors under the micro pension scheme and default fund for all active contributors that are 18 years and above. Then we have Fund 6, which is strictly for those that choose to have their contributions invested in non-interest money and capital market products. Default fund for all active contributors that are 49 years and below. In the pension industry, we have 2 key operators in that industry. However, they could be classified into 3 as follows. The scheme is fully funded through the monthly pension contributions that are remitted into an employee's retirement savings account, RSA, and managed by the pension fund administrators, that's the PFA. There are about 21 of them, and we have the pension fund custodians. There are about 4 of them, and we have the closed pension fund administrators in Nigeria. Now, the pension fund administrators are those who receive these contributions from employees and employers directly, take their commissions, and remit this same fund to the pension fund custodians who manage the fund by way of investing them to generate returns for retirees' benefits in the long run. However, the 7 closed pension fund administrators are those pension fund administrators. They are referred to as closed administrators because they are self-sustaining. They receive the fund, they invest them, and they settle their employees at retirement age. Now, let us look at a simple illustration. This is an hypothetical question. Let's assume a company has an opening balance of planned assets of 20 million and liability of 44 million. Then the company's return on investment or interest charge is 5%. Then the period contribution for that year is 3 million. The benefit paid that year, 5 million. Fair value of planned assets amounts to 22 million and liability 55 million. Current service costs 10 million, past service costs 8 million. All these details were given to you, and you are required to show the values that would be reflected in the statement of profit and loss and comprehensive income. Let's see how we are going to solve this in the next slide. Now, you see in this slide, we have separated both items into planned assets and liabilities. Then for the asset, you start with the opening balance, which is 20 million. Identify all the inflows that will increase this amount. Obviously, the return on investment will be an increment to it. Then 5% of 20 million will give us 1 million. Then the period's contribution of 3 million added to this will give us a total inflow of 24 million. But recall in the question that benefit was paid for 5 million. When you deduct that from the inflows, you have estimated planned asset of 19 million. Now, remember that ISA 26 requires pension fund administrators to value their assets using the fair value valuation. So an actuarial who was invited to value this estimated planned asset, and the value was placed at 22 million, which means we thought we have 19 million, but their experts is telling us that our 19 million actually worth 22 million. So we have a gain of what? 3 million naira. For the liability, we also start with the opening liability of 44 million naira. At this case, we are going to be charged some interest for this debt. So the interest is still at 5%. That will give us 2.2 million. And then there are other costs we incurred during the period. And this cost amounts to 10 million for the current year. And then the past year, which is an accrued sum of 8 million. The total now making it 18 million. So the total debt so far amounts to 64.2 million naira. But benefit was paid irrespective, so we have to remove that from that to give us the estimated liability. And our estimated liability now became 59.2 million naira. However, based on ISA 26, we also invited the actuarial to give us a valuation, which he valued our liability at 55 million. Now, understand this. You thought you are owing 59.2 million, and an expert came to say, no, your debt is actually 55 million. So have you gained or you have lost? So you find out that it's a fair value gain of 4.2 million. But this is just the working. We want to show, out of all this, which of these will be relevant in our profit and loss statement section, and which will be relevant in the comprehensive income section. So on this slide, you will see the abridged statements. For the profit and loss, we have operating costs, which are the service cost of 10 million will be captured, and the past service cost of 8 million, which is an accrued cost, will be captured. Then for the comprehensive income, you must remember those items, the requirements of the figures, items that will be treated under the comprehensive income. You find out that fair value gains are part of it. And we have fair value gains of the sum of 7.2 million from both the assets and the liability. I'm sure you find this video interesting. Always feel free to post your comments. Thank you.